In 2010, the massive overhaul of the U.S. financial system, known as Dodd-Frank, was signed into law. The legislation was designed to fix issues that helped contribute to the financial crisis and protect taxpayers for having to bail out big banks and financial services firms like AIG. But 5 years later, are we really any safer? Steve Liesman takes a look.
5 years after the passage of the landmark Dodd-Frank financial reform bill, the debate rages about whether the system is safer from another catastrophic meltdown. Some top regulators say it is.
By having more capital and liquidity and a safer and sounder financial system, we hope that we are preventing future episodes like the devastating one that we just lived in. And if there is some burden that's associated with that and some costs, the benefit is a far reduced chance of a financial crisis.
But ask a Republican and you'll get a very different answer.
This is bad policy and worse economics. It erodes market discipline and risks further bailouts to be paid mostly by lower and middle income tax-paying families. It becomes a self-fulfilling prophecy, helping make firms bigger and riskier than they otherwise would be.
It's hard to figure out the truth amid such divergent opinions, but a couple things are clear. As a result of Dodd-Frank, banks hold more capital on their books, almost 3 times more capital than when the financial crisis struck. That means taxpayers are safer from being asked to bail out a big bank if it goes down. And the banks themselves are less likely to crash and burn. The big banks also undergo a stress test every year, where regulators scrutinize whether they can withstand a disastrous economic shock. Most pass, but when they don't, they can be banned from buying back shares or paying dividends. And in what are called living wills, banks have to provide a blueprint for how regulators can take a bank apart and sell it off in a worst-case scenario. To be sure, the biggest banks are bigger, and there's no strict prohibition on the government bailing out a bank. The whole Dodd-Frank system is unproven, and the living wills have been criticized for not providing enough detail. But the real question is not, are we safer? The real question is, at what cost? In other words, does Dodd-Frank go too far?
Lending is still not recovering from the financial crisis. And if you look at the average post-war recovery period compared to where we are now, lending is still down, housing starts still haven't fully recovered, and part of that is the regulatory apparatus.
Dodd-Frank has meant thousands of new pages of regulations, many of which are incomplete, battalions of new compliance officers inside the banks, and a regulatory burden that small banks say undermines lending and economic growth. But all of that cost for a safer system, which surely runs into the tens of billions of dollars, is weighed against the cost of the financial crisis itself, which ran into the tens of trillions of dollars. For Nightly Business Report, I'm Steve Liesman.